Hello everyone, this is Ted Bauman here, editor of the Bauman Daily with the Bauman Letter and a Profit Switch. Today I'm going to shamelessly punt my next newsletter, and if you're interested in subscribing to the Bauman Letter, you can click on the link above my left shoulder or in the link in the description of this video below. And I'm shamelessly punting it because that's what I do for a living. And I'm going to do it this way by explaining an opportunity which I think is unique. You can get access to these kind of opportunities through my newsletter for very low price on a yearly basis, and of course it is totally risk-free. If you don't like what you see, what you're experiencing, get your money back at any time. You keep everything that you got while you're subscribed, and you get to get your money back. But that very rarely happens, thankfully. All right, let's talk about the biotechnology sector, and I want to start with a sad story. It's a story about a big mistake I made a while back in the biotech sector. Biotech, when I say the word biotech, what I really mean is the whole kind of, the whole cluster of activities around developing new treatments for the human body using both medications and new biological techniques like mRNA technology and so on. Excuse me. Now, a while back, I spotted a company called Amaran PLC. It is an Irish company. It had decided that it wanted to address a kind of unusual but really significant medical problem, and that is that a lot of people who have high cholesterol, who are taking statins for high cholesterol, also have very high triglycerides. Triglycerides are a form of fatty acid, and basically something that leads to plaque in arteries. It can lead to serious problems with your heart and your brain, strokes, heart attacks, things like that. So this company realized that fish oils, omega-3 fatty acids, had an effect, a very small effect on triglycerides. And so they set out to develop a form of fatty acids that could basically reduce triglycerides to a very significant extent. They did that. The drug was called Vasipa. And the drug went through 2 big clinical trials which demonstrated that it did have a very significant impact on cardiovascular events in people in that particular class. Now, that's a lot of people, so that's a lot of potential money. So the stock went up, and I found out about it. It came to my attention. And I bought it on a pullback for my Bauman Letter. I put it in the home runs portfolio because it's a highly risky stock, as all biotechnology stocks are. I'll explain why in a moment. And here's what the chart did. This is, we bought the stock back in April 2019. I bought it at a reasonable dip. It pulled up in July. It pulled up nicely in December, and then it just fell off a cliff. Now, and then I ended up selling at a loss. It did pick up a little bit later, based on the ongoing evolution of the story that caused it to fall. But right now the stock is, almost in penny territory. So why did this all happen, and what did I learn from it? Well, number one, this particular formulation of omega-3 fatty acids was unique in the sense that this company had developed a way of refining fatty acids that had this unique effect. But another company launched a generic version of the same drug, and Amaran sued them, saying, hey, you violated our patent. A U.S. judge ruled in favor of the generic company, saying everybody knows, it's common knowledge that omega-3 fatty acids reduce triglycerides, that they have this effect, so therefore you may hold a patent on it, but it is invalid. Now, that is what caused the stock to crash. The little bump that it experienced a little bit later was when the thing came up on appeal. The appeal was denied. Now, this illustrates the big risk of biotechnology stocks, particularly first-stage biotechnology stocks, the small companies that are developing the fabulous drugs, the ones that have the potential to be game changers. It all depends on things over which we as investors have absolutely no control, and that includes things like the Food and Drug Administration and the patent system. Now, what happened with this particular drug was that they had patented something which the judge believed was not it was common knowledge that this had this effect. Pretty much everybody in the biotech sector disagrees with the judge, but the judge has the final say. So my decision to hold the stock after its big fall was based on the fact that, hey, everybody who knows this stuff knows that this is not a valid judgment, or it's not a valid conclusion, because this particular compound has this effect. It only has this effect because of what Amaran invented as a process for refining it. How can you rule that it's not patentable? Well, the appeals court upheld the judge's ruling, and we all lost our money. Now, what that taught me was, number one, biotech stocks are extremely risky, especially the ones that have the potentials for the greatest gains. They're risky because precisely these kinds of factors. The first risk is that you never know if a drug's going to work. So, for example, I bought Amaran after Vascepa had been through 2 clinical trials that showed that it was successful. If you buy a company before a clinical trial and it turns out not to be successful, you lose a lot of money. The second thing that could happen is that the FDA may not approve the drug for some reason, or it could take forever. And during that period, your money is tied up. You often go into the red because of there'll be big sell-offs on bad news from the FDA. And then the third thing is you get these crazy patent arguments. And in this case, I continue to believe that that judge was wrong, and so do most people who look at this sector. But what can you do? That's what it is. So the bottom line is that the risk-adjusted return you can get from pharmaceuticals and biotechnology stocks, particularly the leading edge, the new development drugs, is extremely low. In other words, when you account for risk, your potential returns have to be adjusted downward. So sure, you could make 300%, you could make 1,000%, but you'd also lose all your money, or almost all of it, as was the case with Amaran. Now, the reason I recount this story is because we're starting to see a resurgence in biotechnology investment. I'm going to show you the investment figures just now, but let's just consider somebody or a company that has really hit the big time. Moderna. Now, Moderna's market capitalization was $5 billion when it went public back in late 2018. You know what it is now? It's $156 billion. Here's the chart for Moderna. It shows basically that the stock dawdled along. It started to pick a little bit up in the 2020s, but when that vaccine was approved for use, you can see what happened. That vaccine, it's mRNA vaccine, the one that is one of the 2 major vaccines in use in the US and around the world. The stock picked up. It pulled back a little bit with the rest of the market, twice, once in January, once in May, but look where it has gone. I mean, that's the kind of stock chart that everybody wants to see with an investment. That's the 50-day moving average, the red line. It's just so far above it you can't even begin to imagine. And then look at the moving average convergence. I mean, you don't see charts like that a lot, folks. So that illustrates the opportunity. And this is not an isolated opportunity. Here's a chart from the Economist that shows a basket or an index of biotechnology stocks versus the S&P 500 going back to 2010. And there's no question that the biotech sector has roundly, just completely trashed the S&P 500. But look at the volatility. Look at what happened in 2015, early 2015, a big pullback. I can't recall what the reason was, but then we traded sideways for quite a long time, and it wasn't until COVID that we began to see this big uptick with the dark blue line, the biotech sector pulling away from the rest of the market. And that illustrates exactly what I'm saying, that this is a very volatile sector. You can make a lot of money, but you can also lose a lot of money, and sometimes you need to be patient in a white knuckle way, which is basically means trying to grind your way through these approval processes and everything that can scare people. Now, here's a second chart also from The Economist that shows venture capital pharmaceutical or for biotech and pharmaceutical, and there's a definite trend here. You can see it's up. Big spike in 2018, 2020. Obviously, a lot of people put money into companies like Moderna. We're just a little bit this is just halfway through the year in 2021, and we're almost to 2020's entire expenditure. Now, that tells us that this is a sector that is attracting a great deal of money from venture capital. Now, the venture capital means that these are the pre-public companies. These are the companies that are about to go public and might have the next big thing. And that just shows you that the people with the smart money, with the big money, are going after these stocks. Now, why are they doing this? Well, there's some people say, well, it's because they want to produce products that actually benefit society. But the real reason is because of those spectacular gains. You can see what happened with Moderna. You can see the kinds of gains that you can make if you get it right. The problem is that getting it right is an extraordinarily difficult thing to do if you're not fully immersed in the biotech sector. Really from the biotechnology standpoint, you need to know your stuff as, in terms of biotech, not just in terms of stocks, because nobody knows. They're constantly throwing out new opportunities, but how do you know which ones are going to be the successful ones? Now, remember, a lot of these potential startup drugs, these first-order drugs, the pre-public company drugs, are the result of really recent advances, like the mRNA technique that Moderna came up with, which is essentially using messenger RNA to carry a message to human body cells, telling them to produce an antibody to a virus that your body's never seen. That is revolutionary. It has changed the game for antiviral vaccination or vaccines. With all the things out there, all the other viruses, the Zikas, the Ebolas, all those kind of things, there's now a way forward for actually immunizing people against these terrible diseases. So these are all cutting edge things. And a lot of people resist these because they are cutting edge and they're worried that they don't know what the long-term effects are going to be. Whatever the case is, whether it's cell therapy, gene therapy, autoimmune therapy, all of these things are new. And knowing which ones are going to succeed and which ones are not going to succeed is a specialist job. Now, as I explained, my experience with investing in Amaran was that you can get burned very easily. So does that mean I'm not going to invest in biotech? Absolutely not. But I'm going to do it the smart way. I'm going to let somebody else sift through the opportunities and identify the ones that are going to make the big gains and then hand some of those gains to me as an investor. How am I going to do that? I'm going to do that through something called a closed-end fund. Now, I mentioned closed-end funds in Your Money Matters video recently. I'm very enthusiastic about them. And let me review what they are. Here's a chart that shows a comparison between ETFs, exchange-traded funds, CEFs, and mutual funds, which are the three most common types of investment funds. Now, an open-end fund is one where money can come into the fund and out of the fund at any time. A closed-end fund is one where the money comes in once and that's it. The fund never adds more capital. So their job is to get the best return they can possibly get from a fixed pool of money. And as a result, it can trade like a stock. But unlike a mutual fund, which only you can buy through your broker, only is priced once a day. You can trade an ETF like a stock, but ETFs can also accept new money and they disperse new money all the time. That doesn't have an impact on your share price, but it does change. It's fundamentally a different animal from closed-end fund. Closed-end funds do tend to have higher expenses because, as the next line says, they are actively managed. There are people with high experience in both investing and in biotechnology, PhD biochemists and so on, who are the managers of these funds. They're the ones going out looking for the best options. And because they're actively investing, you got to pay them for that. As I said, because the CEF is a fixed closed-end fund, you only get one set of shares. They never issue no shares except sometimes as a form of dividend, which I'll speak about in a moment. But unlike ETFs and mutual funds, there's no possibility that you can suffer dilution as they issue new shares. Now, the share price for a CEF trades in relationship to its net asset value. The net asset value is the value of the shares of all the companies that are held by the fund. Now, it can trade from more than that, or it could trade from at less than that. And when it trades less than that, that's a great buying opportunity. A mutual fund also does that, but then you pay a premium for every share that you buy. In terms of ETFs, by definition, index funds are usually trading at almost exactly net asset value plus whatever the daily bid-ask spread is. So you may pay a little bit more, a little bit less, depending on the day, depending on liquidity. Of the three, only CEFs can use leverage. Leverage allows them to borrow money against their holdings and invest in more of those holdings to earn a higher return. They can do that because the lenders, the hedge funds and the big banks that lend to these funds know that they have a fixed amount of capital. They can't dilute their business is to try to increase the value of their funds, so they can borrow. They can also use options. Now, CEFs can also trade bonds just like mutual funds, but for the most part, I'm interested in CEFs that trade stocks, and particularly pharmaceutical and biotech stocks. Why do I like them? Well, here's a chart, and I know you're not going to like this. Some of the people are going to say, well, why don't you just give us the ticker, man? Well, I'm not going to give it to you because that's my job. I want you to go ahead and find it for yourself or sign up for my Bauman Letter. But basically, this chart shows a particular CEF that is based on the biotechnology sector. Now, I'm comparing it to the S&P 500, the red line. Now, what you see here is that this particular fund tracked the benchmark, the S&P 500, for most of the time up until earlier this year, right? That means that for the most part, the biotech sector, the underlying value of this fund, and people's opinion of it, their willingness to buy this particular CEF shares, were close to the S&P 500. But look what's happened since late February, early April. The fund has traded sideways. It's traded sideways because a lot of people believe that the biotechnology revolution, was a one-time thing with Moderna and Pfizer and all these other things related to the vaccine. And so they pulled away, they rotated their money away from biotech, and they've rotated it into other kinds of stocks, which, essentially is what's kept the market going higher. But you can see that there was a pretty strong growth trend, the green line, up until this point. Now we're trading sideways. And that, to me, indicates a buying opportunity for biotechnology stocks and for CEFs that hold them. Now, as I mentioned earlier, one of the critical things about any CEF is to understand its net asset value, or NAV. The idea is that when you look at a fund, you can immediately understand the value of its underlying assets by simply looking at the current market capitalization, the market price of the stocks that it holds. And of course, it has to be very transparent about that. Now, here is that same fund going back over a period of about, I think this is about 5 years, yes. Now, the blue mountain is the price of the fund. The NAV is the net asset value of the shares that CEF holds. Now, look at what happened in about 3 years ago when the biotech sector pulled back in 2018. The price of buying the closed-end fund, which holds a basket of shares whose value is represented by the red line, was less than that basket of shares. At one point, you could get exposure to a basket of biotechnology stocks for 20% less than you could by buying them directly by buying the CEF. Now, obviously, you've got to factor in exchange, the expense ratios, and you've got to factor in risk and all that. But for a long time during 2018, you were able to get exposure to some of the hottest biotechnologies in the world, biotechnology companies in the world, by buying a CEF and then letting it ride. Now, eventually, the value of this CEF began to catch up. And at the beginning of this year, it did catch up. And both of them have pulled back. But look what's happening in the far upper right corner of this chart. We're starting to see, again, that the net asset value of the companies that this CEF holds exceeds the cost of buying the CEF. That's part of the magic of holding CEFs in a sector like biotechnology. It allows you to buy interest, exposure to the potential profits of a basket of companies that, as an individual investor, you would know which ones to buy because you have to be an expert. So you let these guys do it for you, you buy it, and if you can buy the fund at a lower cost than the actual shares, eventually the value of the fund share is going to catch up to the value of NAV, and then you're going to score. Question is, how do you make money? Are you going to get the explosive 300% growth or 1,000% growth that you get from a Moderna? No. But what you are going to get is regular price appreciation as the value of the underlying stocks increases, but you're also going to get something which is incredibly important that I keep talking about, and that is dividends. The average dividend payment from a CEF in the healthcare sector is around 7.5% paid quarterly. 7.5%. Now, I know a lot of people, younger people especially, poo-poo dividends, and they say, hey man, you're old hat, you're an old foggy, why are you worried about dividends? Dividends are where it's at, folks. Dividends are why we invest in companies. Even if you're not taking, even if a company isn't paying dividends, ultimately what you're buying is the value of their future earnings. A CEF that is currently distributing their earnings at a rate of around 7 to 8% per annum is giving you something now that you may or may not get in the future from growth stocks that may or may not work out. How do they do this? Well, they do this by growing the value of their NAV, by using their investments and their constant rotation of investment strategies to generate income for themselves, which they then return to you in the form of dividends every quarter. Now, as I said earlier, you can actually take those dividends in the forms of more shares in the CEF, which is the only time when they're actually creating more shares, but they're creating them just for you. Now, when that happens, you're compounding, which I'm a big fan of. You get fantastic growth rates. One of the CEFs that we hold in the Bauman Letter, not in healthcare, but in the it's in the real estate sector, has gained us over 70% in a little bit more than a year versus about 50% for the S&P 500. Now, its gains in terms of raw share price increases are only a little bit higher than the S&P 500. Where the real magic comes in is the compounding. That's how compounding can raise the value of your investment. But the key thing here is that when these funds are issuing this, they're not just running down the value of their own capital. They're buying and selling shares in biotech companies. They're earning profits. They're returning those profits to you. And their policies are to keep paying those profits at those rates indefinitely. Now, occasionally, funds can go bad if they're badly managed, and they can end up running down the value of their underlying assets in an unsustainable way, and you want to watch out for that. That's where people like me come in. The Bauman Letter, I look for CEFs that are not doing that. I look for the ones that are distributing sustainable dividends at a very high rate that you can compound and make a lot of money. So that's my message for you today. The biotech sector is hot, and it's temporarily pulled back because it got overextended earlier this year. But as the chart I showed you earlier shows, we're in a sideways consolidation, and I guarantee you it's going to catch up as more companies begin to announce and develop more treatments based on the new technologies like mRNA techniques. And that means buying CEFs in the healthcare sector right now is a way to increase your gains in a much, much safer way, lower your risk. You get much higher risk-adjusted returns than if you did it by, basically trying to pick and choose between the myriad of biotech companies out there. The next issue, Bauman Letter, is going to be announcing a healthcare CEF that is poised to break all kinds of records and pay outstanding dividends. I love it. It's a stock that I think you should own. So if you're interested, click that link, sign up. Talk to you again next week. Bye.